All right, I'm here with Benjamin Rode, who is special counsel at the law firm of McCarter English, headquartered in Boston. Ben, you're known as an expert on the Jobs Act, and I want to thank you for being on our show today. And I want you to tell our viewers, what is the Jobs Act?
Well, the Jobs Act, which stands for Jumpstart Our Business Startups, was passed back in April by large bipartisan majorities in both houses of Congress. And the act aims to promote economic growth and job creation by lowering barriers to raising capital, particularly for businesses with under $1 billion in annual gross revenue, which the Jobs Act refers to as emerging growth companies. The Jobs Act affects 5 significant changes to federal securities laws that are intended to make it easier for private companies and smaller public companies to raise capital. First, the Act eases the prohibition on general solicitation and advertising when raising capital from so-called accredited investors in a private offering. Second, the Act increases the amount of capital companies may raise in a mini IPO using Regulation A. Third, the Act eases the mandatory reporting triggers under the Securities Exchange Act. Fourth, it reduces some of the regulatory compliance burdens for emerging growth companies when they go public. And finally, the Act provides for equity-based crowdfunding, which will eventually permit privately held companies to raise up to $1 million from anyone through certain crowdfunding websites that are registered with the SEC.
Now, Ben, you cite a study by the SEC done in 2011 that stated that the financing undertaken pursuant to Regulation D is now the dominant method by which companies raise money in the U.S., and both in terms of amount raised, overwhelmingly a number of transactions are under $1 million or less. So today, under the current rules, you must be an accredited investor in order to participate in a Regulation D financing. Going forward, through the crowdfunding aspect, then you will be able to solicit funds from non-accredited investors.
Broadly speaking, that's true. There are a few exceptions that allow sophisticated investors that don't meet the financial requirements for being accredited to participate in Regulation D financings. But most Regulation D financings are limited to accredited investors. And yes, crowdfunding will eventually allow companies to raise money from people who don't qualify as accredited investors, so long as they're raising money through these intermediaries, these crowdfunding intermediaries.
Now, you touched on this earlier, but I want to get into more in depth. The Jobs Act will also make it easier for emerging growth companies to raise capital by amending the Section 3B, the Securities Act 1933, to exempt from registration any class of equity debt or convertible debt securities sold in an offering where the amount does not exceed $50 million in any 12-month period. Now, this is groundbreaking, a very significant change in the rules, if you will. Talk to us more about how that will play out and what you think some of the issues will be.
Sure. That provision of the Jobs Act is a modification of an existing regulation called Regulation A, and it's now being deemed Regulation A+. Regulation A has basically permitted companies to raise up to $5 million under similar restraints as the new regulations. However, because of all the state regulations that companies are compelled to comply with, $5 million hasn't been enough money to make that kind of fundraising cost effective. The hope by the authors of the Jobs Act is that by raising the threshold to $50 million, it will be more cost effective. And so this may, depending on how strict the SEC rules are, it may actually become an entirely new avenue for companies to really raise a significant amount of capital without having to file a formal registration statement.
They must have, though, however, they must have the audited financials.
Yeah, there's still there's still a number of information requirements that that companies are going to have to comply with in order to use Regulation A+, and a lot depends on how on what kind of requirements are imposed by the SEC, and a lot as well as to what extent the SEC mandates that that federal filing or compliance with the federal laws will preempt state laws, and we're still waiting to see on that.
Okay. Now the Job Acts, and again we touched on this earlier, will allow people that are not registered with the SEC as a broker or a broker-dealer, will allow them to offer, it's do an offering to raise money for a company under Rule 506, as long as they don't receive compensation. So if I go out and I find investors to give $1 million to company A under this Rule 506, I don't have to be registered with the SEC, but then I cannot receive compensation for bringing that capital to the table, correct?
There are some, the SEC, the Jobs Act tries to clarify what exactly company or individuals or companies can and can't do in terms of helping raise capital. So that stems from the fact that there's been a lot of confusion about whether sites like AngelList, which provide a forum for companies to reach out to potential investors, whether that is considered to be acting as an unauthorized broker-dealer simply because they've allowed the companies to post on their site about their fundraising. And so the SEC is trying, or Congress is trying to carve out an exemption for that type of activity. Gotcha.
But under the existing or the proposed rules, then a finder, if you will, cannot be compensated in connection with the sale of those securities. So, again, so what does this mean in the marketplace? Does this mean companies like, say, Kickstarter or FundMe or GoFundMe will maybe charge the entrepreneurs or the company a fee to be on their site because they're not going to be able to take equity or get a commission, if you will?
Well, platforms like Kickstarter right now don't sell equity securities. The crowdfunding through those sites is reward-based crowdfunding, and therefore it falls outside of the SEC's jurisdiction. But the new generation of companies that are going to do equity-based crowdfunding, for example, WeFunder, are going to, it's not entirely clear, but they will likely end up taking a small piece of the transaction. But they'll be required to register as a crowdfunding intermediary. The exact rules about what the companies will and won't be able to charge is still yet to be determined. But for Rule 506 offerings, the current rules essentially prohibit an unregistered broker-dealer from taking a piece of the pie, essentially, in an equity raise. They can charge for various other services, but you can't be paid a commission unless you're a registered broker-dealer. That is largely continued in the new rules under the Jobs Act. The difference is the SEC has said, or rather the Congress has said explicitly, that certain types of activities won't constitute acting as a broker-dealer. The big exception being you still can't take any money.
Right. No, got it. What are some of the major issues that the SEC is grappling with? These rules were supposed to be issued by the end of this 2012. Hasn't happened. I know one issue, big article in the New York Times this weekend, is how do you prevent outright fraud?
Yeah, fraud has probably been the single biggest concern expressed by people about the Jobs Act, and what the Jobs Act does is it really expands access to capital for companies by making it by reducing the number of regulations they have to comply with, by reducing the amount of information they have to provide when they're raising capital. But the flip side of that is, of course, that investors will have less information at their fingertips. There won't be as much oversight. So there's a lot of concern that your mom and pop investors won't be able to sort of separate the wheat from the chaff. And the SEC is grappling with ways in which they can sort of walk that line to make sure that those investors are protected as much as reasonably possible, but at the same time they fulfill the mandate of the Act, which is to make it easier for companies to reach out to investors.
Do you have any ideas on how to prevent fraud with this crowdfunding?
Well, crowdfunding is the concept of crowdfunding is really that the crowd, the sheer number of people that will be seeing these companies, vetting them, asking questions about them, will help to reduce the risk of fraud. This isn't going to be somebody going door to door and asking for a few $100s or a few $1,000s from somebody to invest in a company. These companies are going to have to list and provide specific information on these crowdfunding intermediary websites. Those websites in turn are going to be regulated by the SEC. They're also going to be regulated by FINRA, and that's going to incentivize them to police any fraudulent activities. So there are a lot of safeguards in the Act that will help to reduce the risk of fraud. But I think the bottom line is that there's no way of preventing fraud entirely, as we already know is the case under existing rules. So the Jobs Act is really an attempt to rebalance the scale between regulation and freedom to operate.
But isn't the issue is you're going to have less regulation? But you're saying there'll be rules for these intermediary websites that are offering these, making these offerings for these companies. But again, one of the issues is for the SEC is there's less oversight. Won't this open up these crowdfunding sites to lawsuits if some of these companies are found to be frauds?
Well, that is a concern, and that's a concern that's being discussed right now between the various companies and groups in the industry, in the crowdfunding industry that's emerging, and the SEC. They are concerned that if the platforms are exposed to a lot of liability, that the result is they're going to have to charge more to companies, and that's going to eviscerate the real benefits of crowdfunding. And we don't know. I mean, the fear among the crowdfunding industry is that the SEC and FINRA rules will be so strict that it will make crowdfunding really not cost effective. But we haven't seen any proposed regulations yet, so it's a little too early to tell.
Well, we see lawsuits against investment banks when their clients that they've raised money for have committed fraud, and they failed to uncover that fraud. And particularly in the China space, we've seen companies like Rodman and Renshaw sued by a number of institutions and investors because they didn't detect fraud in the clients that they raised money for from these institutions. And so that seems to me will be a huge issue.
Yeah, it may become a huge issue. But first of all, it's important to remember that the dollar amounts we're talking about in crowdfunding are considerably lower than your typical public offerings. So that will limit the loss both to company or to individuals and to the companies that are acting as intermediaries. But there's also the fact that crowdfunding, rewards-based crowdfunding, has now been going on for a couple of years now. It's growing by leaps and bounds year over year, and there have been remarkably few reported instances of fraud. So it does seem like at least the anecdotal evidence is that the crowd is reasonably good at weeding out whatever fraud there might be.
Very, very good, very good. What do you think the single most important aspect of this Jobs Act is?
Well, I think ultimately the crowdfunding piece is the most revolutionary, and that really that could be a game changer for emerging companies because it gives them access to a totally new source of potential capital. However, in the near term, I think the changes to Regulation D that will allow general solicitation really important. And the IPO on-ramp, the portion of the Jobs Act that basically allows companies, these emerging growth companies, to go public and remain public for a few years without having to comply with some of the more burdensome aspects of Sarbanes-Oxley and Dodd-Frank, really could have a tremendous impact on the number of IPOs we'll see in the next couple of years.
Well, I do know that you see companies on the NASDAQ, the New York Stock Exchange, with revenues under 100 million are currently required to comply with Section 404B of SOX, which requires a report by an outside auditor, and it requires the CFO or an officer to sign off on these quarterly reports. Under on the Jobs Act, as I understand it, correct me if I'm wrong, if the company has less than $1 billion in annual gross revenue, then they will be exempt from the 404B of Sarbanes-Oxley.
They will be exempt from 404B for a period of time, up to 5 years following their IPO.
Okay, so that's a very substantial change from what we're seeing now. It's huge. I'm sure it's one of the issues that the SEC is grappling with and is concerned about. At the end of the day, I want you to conclude by giving us your. Let me ask you this: are you an advisor to the SEC on the job? Are they consulting you, because you are considered an expert in this area?
I haven't spoken directly with the SEC. I have spoken with the Massachusetts Securities Division about their response to the Jobs Act, and I'm also working with companies that are looking to become crowdfunding intermediaries under the Jobs Act. Fantastic,
and we want to make sure that all of our viewers understand how to get in touch with you. So tell us what's your website, and how do companies that want to work with you get in touch with you?
Our website is www.mccarter.com, and I am reachable at bhron@mccarter.com.
You see that up on the screen there. Ben, it's great being with you today. Thank you so much, and we hope to have you on again soon.